What is going on, guys, and welcome into the video. Well, we have the CPI release coming on Thursday, and it will dictate the movement of stocks over the next month and actually through the end of the year, and will absolutely determine the course the Fed takes next. Basically, this number will determine if we get the holiday rally everyone is hoping for and Santa comes early, or if the stock market just takes another leg down and Santa stays home instead. So let's discuss that today and exactly how to handle this possible destruction or huge run in your stocks. I just ask that you hit that like button, and if you aren't subscribed and you enjoy this kind of content or my videos in general, make sure you click that subscribe button too and turn on notifications. Even if you're subscribed, turn them on, otherwise YouTube is dumb and they won't show you my videos even if you are subscribed. Inflation has hit really hard, guys, there's no doubt about it. But we may have hit that inflection point the last couple of months, maybe, I'm saying maybe here, guys, not all the way, but we need to see inflation continue to move down to actually reverse the trend. And remember, yes, it's finally flattening out, but it's not come down in any meaningful way yet, and items like rent and food continue to go up in spite of everything that's going on. And actually, we hit this type of inflection point last year before inflation decided to take off again, so we need to have the moves down and be much larger moves down than we've had so far to kind of stem those fears that it will get wildly out of control again like it did last year. But given that the Fed finally decided to get aggressive this summer and the hikes typically take months or sometimes even longer to show up in the inflation data, I don't think the rate hikes have had the effect yet to stave off inflation, so we may actually have to wait until next year to see any big inflections to the downside. Now, I'm not saying it's impossible, just saying it's totally probable that we don't see huge inflections downside till next year. Last month's number was down once again, but not down to where the consensus estimates were despite energy prices declining significantly. And that's a problem to say the least because many were thinking there was a possibility of a 7 at the front of that number, and it just didn't happen. Add in the fact that rent has continued to trend up, not as aggressive as before, but still trending up, along with food remaining high, elevating and continuing to trend up as well. And it seems clear to me that the number was not going to come in as low as expected. But on the flip side, last quarter the inflation narrative was moved from it hitting the companies to it being more of a factor for the consumers. So that's good news for the companies, but not the customers, obviously. We had several earnings calls last quarter mentioning the cost of raw materials are coming down and basically starting to hit those bottom lines. And kind of looking across the data, you see stuff like lumber and all the other commodity prices all plummeting. And you have shipping costs continue to decline, basically plummeting too. And all the costs around moving are just basically going all in the right direction, or moving down is what I'm trying to say. If I could actually say something today, guys, I'm sorry. Unfortunately, the ridiculously hot job market just continues to chug along with the fact that instead of contracting like most expected, the economy actually grew again last quarter. That's going to allow the Fed more headway to be aggressive and to stay aggressive. The Fed is actively trying to create more unemployment, and so far they've not been successful in any meaningful level despite all these rate hikes and everything else that they're doing. And I mean, it's not like they're hiding this, guys. They are openly saying it in their statements that they're trying to get more unemployment to happen. If we could just get that number back to normal, never mind high or anything else, just back to normal, it would really help the inflation fight. And don't worry, if it does go back to normal, which basically means in the 4s, 4 to 4.5% or so, which is where it should be during normal times, the YouTube and the media freak out about mass layoffs and unemployment and doom and gloom, worse than the Great Recession. Maybe even a Great Depression is coming, is going to pop off everywhere. Again, the Fed is actively trying to create more employment, not increase employment like they did in 2009 forward. So any talk of this being like the financial crisis or worse is just comical, and there are other motives at work there, guys. I'm sorry. You just got to ignore that noise, as unemployment back during the Great Recession was, 9-10% or so? And obviously during the Great Depression, it was well over 20s. Talk to me when there's a 6 in front of that number, as that is when I will be concerned about the unemployment rate. But until we get that, guys, I'm not concerned about it at all. All right, enough of that silliness. So really, there are 3 scenarios that will play out, and I will discuss what I am doing specifically in each one of these scenarios. Let's start with the positive one first, and that is we see it inflect down into the 7s. If we get this, the table will be set for a nice rally to end the year. Then the reason for the rally is because Wall Street will think the Fed will slow down, or at least start acknowledging that their plan is working. Now, it's too early to declare victory and not enough of an inflection down to stop the rate rises altogether. Please don't fall for that narrative either, like many did during the last rally. But Wall Street will start to trade, assuming the Fed won't, basically hike us into oblivion, and keep going. In this scenario, I will continue to buy stocks as they hit my price targets and continue my modified DCA that I've been doing this entire downturn. It seems to be different stocks that I'm buying every week, so I will continue to be a buyer. And let me give you an example of that. In the June lows, many small caps made incredible new lows, and we were pouring money into them. And now many of those are honestly still down, but nowhere close to those June lows, with some even being up 100% or more from those June lows in some cases. It's been incredible. But we got a whole different situation now because you have stocks like Google trading at its lowest valuation ever, but nobody wants a piece of it because advertising is slowing down due to the Fed actively trying to slow the economy, and everybody seems shocked like Google's just going to go out of business. I mean, that's got to be why you push Google to its cheapest valuation ever, right? I mean, it just doesn't make any sense. So there are still great deals out there on many stocks, and I'm going to continue to be a buyer of those and just let Wall Street be Wall Street and be dumb. But the second scenario is we see it really inflect down like to the lower sevens. And if that's the case, Wall Street's going to freak out to the upside and will accelerate and really push stocks up as they start to speculate on the Fed actually not being as aggressive and potentially stopping soon altogether, because that's just what Wall Street does. The market hates uncertainty, but in this case, the uncertainty moves towards the Fed's current plan, basically kind of being a worst case scenario of what's going to happen overall, with a chance that they get more dovish towards the end of the year and the market's going to rally big on that. Even if it doesn't end up being true, it's going to rally big on that. And in this case, my strategy is the same as the first scenario. I would just continue executing buys at my price targets, but I will not get caught up in any FOMO like many did in August and September on that rally. Now, to be clear, I think the Fed will stay more aggressive than what Wall Street thinks that they will. And so if there is a rally and it is big, it's going to correct after the Fed doesn't announce no interest rates in December or something like that. Now, I'm not saying it's going to have new lows or anything like that, but the rally will pull back some as it's going to be a super aggressive rally up. And lastly, we have inflation coming in hot and like not moving at all from where it's at right now, or actually going up, which is a possibility. I don't think the market will wait one single second to sell off everything. They will immediately start to sell stocks because we all know that not only will the Fed continue to be aggressive, they will obviously raise their target rate significantly higher for those future rate hikes. And that's going to induce strong selling pressure into the markets. Now, probably not as bad as the media or YouTube will make it out to be, but it will create big selling pressure in the markets once again. And in this case, I'm going to do two things. One, I will still be buying, but I'm going to be selective, as when we have big fear events like this, the VIX is going to spike and the sell-off will last a lot longer than a day, to be honest with you guys. In this case, waiting a day or two, or maybe a little bit longer, will bring stocks not only into my target ranges, but into the lower kind of parts of those ranges and maybe some into stupid low territory. If that ends up being a scenario and that ends up happening, I will buy as much of the fear as I can during that time. This is where your planning had you buying in May and June, and then it was easy to be patient and not FOMO into the rally that followed, but instead you were pooling up kind of as much cash as possible for an opportunity like this. And this is exactly what we preach in our group, basically doing evaluation, setting price targets, buying the fear and being patient and saving and working to put away cash for the next opportunity when the market is rallying a little bit. That's your time to pull up that cash for the next pullback. That's actually one of the biggest benefits of the group, is just having that support right there and folks to talk to about it. But let me be very clear. If Wall Street wants to get stupid again, please let them. The average bear market lasts 289 days or so, and we're well into it now. And by the time it flips and the numbers look good and you have confirmation that the bear market is over, we are actually in the middle of the next bull run. That's what happens every single time, because you won't know it until after it's already happened. So I'm not going to let opportunities pass me by waiting for this indicator or that indicator or this chart to say this or this line to make this graph and this chart and this thing to hit this and cross that and whatever. Just like during the financial crisis, I will be buying all the arrows on that chart because nobody can time the bottom perfectly, despite the fact apparently everybody out there can time the bottom perfectly or thinks that they can. Hate to bust a bubble here on YouTube and in the media of smart folks, but there is no indicator or formula that tells you when that is, so it's absolutely useless to try to time that event, and I don't know why people still try to do it. Put yourself in a spot where no matter what happens, you are in a win-win position as a long-term investor. So hopefully this was helpful, and if you don't know how to get a price target or how to do evaluation and want a step-by-step process for doing that, building wealth, and you want direct access to me and much more, remember to check out the pinned comment down below to become a member and at least look at everything you get. And click this video here for the stocks I'm still buying in this market, and click here for exactly what I'm doing to make huge money in this market. So thanks for watching, and we'll see you in the next one.